today's session is going to be about stocks, bonds, and Wall Street. I use that in quotes. And we're going to focus really on some tips for success and empowerment, in that you're maybe going to get a slightly different take on things during our presentation here. And it's very intentional. I also know that in this room are some very, very successful investors, and I welcome input. I welcome, even if you want to have counteractive points of view. We're going to do a Q&A and open it up at the end, definitely for discussion, and feel free. This is always meant as a dialogue. This isn't just a one-way street. This is our bringing a forum for discourse to women all across the country and all across the world. So here we go. The number one thing I want to start with is that the stock market is a pillar. It is not, and it looks like it's not a pole. So it looks like somehow the formatting got off, but the stock market is a pillar, not a pole. And what I mean by that is we kind of tend to think of it as this pinnacle to climb, right? It's sort of very domination based in terms of there's the top and then there's the bottom. We hear about it every single day. It's a very vertical kind of thing. And yet what I want to do is reframe the way we even think about the stock market to put it in its place. I really love this, which is by Darius Faroo. He has a really great website if you ever want to check it out, just about different pillars of wealth building. And some people will say there are 10 pillars, 7 pillars, 3 pillars of wealth building. But what it really always kind of gets down to is that the stock market's not your only vehicle for wealth, nor should it be under any circumstances. And so rather than thinking of it as this pole and you want to try to climb it the best you can, and maybe you're going to put on burlap and find all your tips and tricks and everything, you're going to get up that pole. I'm going to flip that over its head, and then I'm going to put it in its place. And we can just imagine it's one of these poles here. And you have a lot of other pieces of the puzzle when it comes to your wealth. And because it's been so dominant, the stock market is sometimes perceived by many of us as the number one place for wealth and wealth control. The other thing I want to help people realize, if they don't already, is that Wall Street's actually highly, highly speculative. If we look at this in terms of a pyramid, okay? Yes, your equities, your Wall Street stuff is at the top because it's just sort of, let's just say it's the most famous. It's the one we most learn about most easily. Often you'll, enter it with your very first job into a 401k. And so it can feel like Wall Street is king or it's at the very top. Well, okay, yeah, maybe it is a little bit at the top, but I'd like you to recognize that at the top, it's very much like this pillar in that it's also much more precarious than many of the other kinds of financial tools that exist. For example, real estate and anything tangible. You own an actual home, you own gold bars, you own art, you own actual things that are yours. That's much more grounded and tangible. And then there are risk management and fixed income tools, things that will give you, let's say 3% guaranteed no matter what, regardless of whatever's going on with the stock market, things that will give you an index between, let's say 2 and 7% guaranteed no matter what, regardless of whatever goes on in the stock market. Those are called non-correlated assets. Annuities, all kinds of other things exist in the financial world. And so actually, when we look at Wall Street and public equities, it's more in the same zone as venture capital, which is highly speculative, and even crypto and NFTs, which, as you kind of see, it's that bang or bust, big potential gains, but no downside guarantees whatsoever. And so when you see those swings up, it's amazing. And when you see those swings down, it's devastating. And no matter what you're trying to do to protect and strategize, there's not a whole lot you can do when it comes to the stock market against those big downs. They just are part of the game. Now, ultra high net worth individuals, and there are many, they know this. If you look at the way the average high net worth portfolio is allocated, okay, they are definitely in real estate, definitely in private equity. That means stuff that has nothing to do with the stocks that we're seeing on the S&P 500. They have all kinds of other commodities, oil, let's say fixed income products like the annuities and other strategies, tax strategies that we mentioned before, cash or cash equivalents. They have hedge funds, which are very targeted, specific plays that are leveraging their money in unique relationships. They don't let public equities compose more than 1/4 of their portfolio, okay, on average, at best, okay? Now, if you look at, and this was the site, so if you want to check it out, there's lots of data about this. Households that are in the 51st to 90th percentile in the United States, they put a lot more into this basket. The average is 37%, so almost 40% of their entire nest egg is in the stock market. So the savvier, more sophisticated, more successful people don't quite leverage that heavily into the market. But those of us who may not have as much either access to good information or inherited wealth or wealth strategies or, information and access or empowerment, we're just kind of doing what's the path of least resistance, which is, well, I guess I'm in my 401k and maybe I'm going to have an IRA and I hope it goes up. And we're all in this little track instead of thinking the way this tool, here shows that one can be thinking about all the different ways we can be leveraging and growing our wealth. So in fact, when you look at 401ks and IRAs and Roth IRAs, and I'll just briefly touch on what those are, for some who may not be fully familiar with what the difference is between all that stuff. The actual fact is 70% of Americans engage in the stock market simply through their 401k and or an IRA. So it's actually like around 40% of people are only in their IRA, and another, almost 30% might have an IRA. Only 20% of Americans have Roth IRAs, which, these are just data points that can really prove that the stock market has been the path of least resistance or the path of easiest entry and the most very basic engagement tool that most Americans are experiencing, despite the fact that out there in the world of wealth, a lot else exists. It just is coming down to the education component and people learning how to even think in this way that we're teaching you today, where that stock market is a pillar, not your pole, not your only pole, not your entire nest egg for retirement, okay? And another thing I really want people to understand, not only are we, most of us, only in the 401k at best, some of us might have an IRA, most of us are not even leveraging Roth IRAs. And I'm going to talk now about what the difference is between those, okay? Your 401k is through work. You can put your money in it pre-tax out of your paycheck. Great. They provide a platform. They typically provide technology, so it's easy to set that up. Awesome. And it's like, great, it's pre-tax. I'm saving money on my paycheck and I'm putting it towards retirement. Awesome. Many 401ks will match a certain portion of what you put in, typically no more than 5%. But if you're a very large organization that's trying to be very competitive, I've seen as high as 7% match, which is amazing. But a lot of smaller businesses, you're looking at maybe no match or maybe a match of only 3% max or 4% max. And that is free money. If they're going to match every dollar you put in your 401k, awesome, take it. Nothing better than free money, okay? But if you're going to go put 12% over and above whatever they're matching into your 401k because you're like, oh, it's pre-tax. I'd like to invite you to think about that a little bit more clearly once you go through this presentation and think about the potential opportunities that you're robbing yourself of and why. And I'll get into that. Because the 401k is funded with pre-tax dollars, and that is on surface quite attractive. But taxes are likely to be much, much higher in the future. So I'll get back to that in a second, but I just want to talk a little bit about what's an IRA and a Roth IRA. An IRA is something you can set up anytime. You don't have to have an employer who provides you with this retirement plan at all. You can go to Vanguard, you can go almost anywhere and set up an IRA. And it, again, is going to be pre-tax money that you put into it. And that's great. It will grow. And then later when you take it out, and you will have to at a certain age, okay, or there are penalties, you will pay taxes on it then. Also, if you take it out early, there can be penalties. Again, nothing wrong with it. IRAs exist for a reason, but they're pre-tax. A Roth IRA is literally the same thing, except you pay with post-tax dollars now so that it grows and grows and grows. And later when you take it out, it's completely tax-free. If used correctly, it's tax-free money on the back end, okay? It's very simple. It's really not any different except for the tax component on that. And here's the thing. If taxes are much, much likely to be higher in the future, in the next slide, I'll show you proof. Okay. And if everyone, or at least those of us here, are leveraging everything into, I want my pre-tax, guess what? You're setting yourself up to be hit with massive tax bills later when taxes are higher. So I invite you to think about, are you really being strategic? Is it really, really, really always best to put everything into the pre-tax funnel? Okay. Because there's massive government debt and there are other things in play which are likely to mean taxes are way higher. So just so you know, literally as recently as the 1970s, the top federal tax rate was 70%. Today, that's unheard of. Many of us can't even imagine a time when in 1943, the tax rate was 90%. That seems preposterous. We're in a culture right now where it's like allergic to tax, right? So even where we are right now, which is around 37%, is considered too high for our taste, right? We hate it. It's too high. We hate taxes. Of course, we hate taxes. Everybody's hated taxes since biblical days, okay? But I want people to understand the framework. This is a historically low tax rate environment, dramatically so. Times are good from a tax perspective, believe it or not. And the government is in massive debt right now. So 98 cents of every dollar that we pay in taxes right now is going towards interest on our debt, on our country's debt. 98 cents of every dollar. That's getting close to 100% is just going on paying the interest. And we all know that's disastrous. And we've just had this pandemic, and there have been all these relief bills that have had to be passed just to keep the country floating, et cetera, et cetera. So odds are the government's going to have to start to crack down on things like estate taxes, and it's also going to at some point have to hike taxes, even though they're not really popular. You can see it's really interesting. When Reagan came, it was really, everyone loved Reagan, and he was great. And I loved him too, because I was a kid and I thought he was awesome. And one of the things he did that people loved so much was cut taxes dramatically. And originally he was going to have it at 28%. And they promised they would never have to raise it again. 3 years later, they had to break their promise because it was just literally unsustainable to do that. And so just looking at the history, okay, if you're doing everything in pre-tax, thinking, great, I'll pay the taxes later, you could be shooting yourself in the foot by setting yourself up to pay massive taxes later when you had them at a historically low tax rate now.
So Jennifer, another thing to add to this too is, and actually next month we're going to talk about macroeconomics and obviously inflation, which is structural now, and the debt. What Jennifer's talking about. The other thing to think about and is that this idea that we'll have a lower tax rate when we're retired, because the expectation is that we'll spend less. What if I don't want to spend less? What if I don't want to spend less? What if I want to have a lot of money coming to me? And then that puts me in that higher tax bracket, right? Because it's not like, think about what we're told in retirement, you won't have that many expenses. What if I want to? What if I want to travel? What if I want to do other things? What if I just want to what if I want to retire early? So it's like, we have to really pay attention to the messages that we're given about how to spend our own money. And this idea of delayed gratification, which again, we'll talk about when we talk about inflation next month and the time value of money and what a dollar is worth today versus what it's going to be worth when we retire. So that's another thing to think about is don't fall into this trap of some kind of weird imposed austerity, when you're old, that you're not going to work. That is just not true. Not to mention the expenses, and we've done a session on this, but the expenses that we incur when we're much older. A lot of us have aging parents. And there's a lot of needs for funds. So anyway, just something to think about. It's not wrong to put money away for retirement, but it's important to understand why and to decide, do I need more money today, or am I through convenience, through a set it and forget it, actually hurting myself today for something that is really not that guaranteed in the future. So just an invitation to think differently.
100%. I'm so glad you brought that up. These narratives are bedtime stories, and we act like children listening to them. I'll be honest, that's what I think most of us do, including me. The very first engagement I had with my 401k was learning all about, get investing is good. The power of compound interest. Fantastic. That is so true. Okay. But what they didn't say is there are a million other tools for also growing your money. And they never got to this thing about the tax stuff. I've had to learn through all of the work I do, the things that they aren't saying. And frankly, in my conviction, okay, remember that these assets under management are feeding someone else who's living off of the money you're giving them. And so it's a very convenient story, right? Put it all in this company 401k, put it all into this IRA. That way I'll have all the assets under management. I live off of those fees, which I'm taking from you, and set it and forget it. And don't look too closely. Let me just have all of your money. That's a very convenient narrative for those who are in the position to be handling your assets under management. And that is a gigantic industry. That's why Wall Street is like, we hear it on the radio every day, how far it's up and how far it's down. It's something to really think about in terms of these paradigms and really thinking outside of the box.
Okay. How do they enjoy spending their time outside of work? What are those commonalities so that we can figure out? I believe you always have some common ground at some point. You just have to figure out what it is and find ways to mutually.
Okay, I don't think that's a question. I thought that might have been a question, but I think someone just needs to mute. Okay.
In our Pittsburgh forum this last 2 weeks.
And AdaPia, can you try to figure out who that is and mute them? Thank you. Okay. All right. So let's get to this. Is the stock market diversified and the index? Like the index is, let's call it the S&P 500. Because the other narrative that I just smile about it all the time and just think, I don't understand any of this. You always talk to an asset manager and they'll talk about diversifying your portfolio. And I'm going to use rabbit ears. It's just a combination of stocks and bonds almost all the time. And they go through the same thing all the time. What's your risk? What's your timeline horizon for a retirement? What's your risk tolerance? Small, medium, large, and they literally all ask the same questions. And then they say, okay, we're going to help diversify your portfolio based on your risk tolerances and your high horizon to retire. Okay. At the end of the day, you're still in that one tool. You're not in any of the other sectors. You're not in real estate. You're not in commodities, really. You're not in gold or silver bars or crypto or NFTs or risk management products or CDs or any of that stuff, right? You're not in any of the other financial tools. You are just literally in the stock market. So that's not actually diversifying. And just so you know, especially in the US, the stock market's not trading based on any kind of real diversification. The biggest stocks in the S&P 500 are accounting for more than half of the benchmark gains. And this was as of December 2021 last year. This was already very clear to everybody. It's like Tesla, Apple, Microsoft, right? Those five were literally responsible for more than 25% of the apparent gains in the stock market. Everyone's like, oh, stock market's doing so great. It's up, it's up, it's up. Well, actually, five massively inflated stocks were doing really great for reasons which were partly due to FOMO manipulation of low interest environments and a couple other things. And talk about bubbles, okay? They were responsible for the appearance of fantastic growth as a whole, when in fact, they were carrying most of the stock market with their returns. And it's kind of prescient because here, this slide was in one of our slides early on in this series and said, look, if these stop performing, there's nothing to support the market. Well, that was in December 2021. And here we are with most people's, assets down somewhere around, 20, 30%. And we're all hating the market because right now it's no fun, right? So when you think you're diversifying in the stock market, you need to understand if you're not diversifying outside of the stock market, you're not diversified. And if you're in the United States stock market, the way it's been behaving, you're really not very diversified at all, unless you're going to dig a lot deeper. The other thing I want people to take is this just new paradigm of understanding that the diversification they talk about in Wall Street is passive. It's very convenient and easy. It is like a bedtime story. Give me your money. It will grow over time. I've got you all sorted. And that's all we do, right? We're like, we give it to you and then we just don't look at it. They send us maybe a statement. We kind of don't know what to do with it and we throw it away. Honestly, that's what most people do. It still is not going to actually protect anybody from downturns or crashes. And what happens when the crashes come? What do the advisors say? Well, don't sell right now. It'll go back up. So it's a very convenient answer. It might in some ways kind of also be true, but I would really like people to think about this as the more cogent kind of paradigm. And no, the 401ks and IRAs, the last crash, which was 2008, lost over 2.4 trillion. Okay. And those who were between 30 and 50 saw minus 30 returns. And those over the age of 60 saw minus 20% returns. Now, one thing I want you to really think about, the older you get, the more vulnerable you are, especially if this is your nest egg. It's terrible to have to start drawing out from your 401k or IRA at a time when it's down 20% or 30%. It's actually really terrible because you're never going to get the next when it goes back up. You had to sell and liquidate when it was low. You lost all of those potential gains, right? So it's really sad if you're not actually diversified right now. It's hard to imagine, but later, and hopefully just seeing the logic of this, you can understand how devastating that can be. Truly devastating. Put all your eggs in one basket. Happens to be the stock market's down when you're turning 65, and all those promised gains, even the gains that on paper looked like they were there 10 years prior, are mostly wiped out or largely wiped out. And there's nothing you can really do about that. And I want people to realize it's kind of happening again right now, right? We're down again 20, 30%. So for most of us, this is already twice in one lifetime that we've seen this firsthand, right? And they talk about, okay, the market bounces back, but every time it bounces back, it's still eating up gains. And the timing, like I just said, of when you need your money is everything, right? If you happen to be able to ride it and then get out again at the top, okay. But first of all, it's hard to have that crystal ball. And secondly, your life is going to have demands on your money, regardless of what the stock market's doing. And so the timing is not often going to be in one's favor. And if you understand that about the market, you're going to be better prepared to interpret some of the other the drip that comes about the stock market that is very, very prevalent. As we know, a typical portfolio diversification is like, okay, some stocks, some bonds, maybe the market's crappy like it is right now. They're going to move you into cash, right? And, you can usually do mutual funds, index funds, and ETFs, et cetera, if you're looking for more like of a bundle. And it's like I said, those very rote questions. Every single advisor asks the same questions. So again, this is all I want people to realize. This is not diversification. This is just more options within the same bucket that they're putting you in. And haven't we all ever heard, don't put all your eggs in one basket? We did a wealth mastery on diversification that talked a lot about this. All right, so that's some of the scary paradigm shifting stuff. Now I want to get granular about what else can you do, because the stock market is a pillar of wealth. It's not like you're not going to do it at all, right? So how can you do it in a more empowered way? How can you do it more effectively? How can you improve your margins, right? Which is what we all really want to do. Well, become aware. So there are many, many, many fees hidden in your stock market assets. So typically, it's around 2% that you're paying in fees year over year in most scenarios, sometimes even more, okay? Whether it's a 401k, an IRA, or a Roth, and if it's managed by a financial advisor especially, for sure you're probably paying around at least 2% fees year over year on those assets under management. Imagine how much nice passive income those asset managers are getting from you and all of the other people in the stock market. So for example, if you are in a 401k, know that the actual setup fees and admin fees and all those other fees that go into having a 401k and offering it, they can actually be distributed through as an expense to the entire employee population. So you can actually be paying for the administration of your company's 401k. And where they take them out of the fees where you don't even see it or know it. Okay. So again, knowing that, it's fine. they deserve money for what they're setting up and everything, these TPAs and all these other services that are providing you that platform. But if you're contributing above the employer match, ask yourself, why? Is this really the best tool? Is this really going to maximize my wealth? Take the free match, and whatever else above that you've got to play with, put it in other things. That's my advice. Okay. Mutual funds also have ongoing operating fees, and that's just for the yearly being in the mutual fund itself, on top of trading fees when and if you get in and out of a fund. And then also the advisors who are attached take their own fees. It's fees over fees over fees, and they're all hidden and baked in. And so I want you just to at least know all of that, okay? Wealthy people know that. Wealthy people say, oh, you're not getting, no, I'm not going to give you 1% for having my assets under management. I'm negotiating that down. They do it. I know services that will do an audit of your fees and then leverage and shop it for you. So wealthy people are very aware that these fees are ridiculous. Okay. And you can, if you like, you can kind of step out of the matrix a little bit and look at E-Trade or Vanguard. There are so many platforms right now where you can have access to managing your own IRA or Roth IRA. And there are so many tools within those platforms to educate you and figure out your risk horizon, all the same stuff. And they tend to have much lower fees. They also are not going to have that additional financial advisor fee attached to it. And so I just want you to know that, because unless your financial advisor, asset manager is really providing you so much more value across silos within context, for example, tax strategy abilities or help with budgeting and fee-based financial planning and other things, or bringing to the table solutions and things outside of just stocks that you never knew about, okay? In that case, yes, that's really very valuable because it's hard to get these kinds of educations. But if they're just like a robo-advisor, just use a robo-advisor or consider it. Because most of those financial advisors are actually literally using software to rebalance anyway. I actually have a client on the employee benefits side who has written the software that the Merrill Lynches of the world use to rebalance. It's just a software doing it. So ask yourself, what am I paying this person to do for me? Are my returns and losses better than average, worse than average? Ask around, okay? And what is the price of my being so passive? Because this is your future. And also, like, how hard is it to engage just that little bit? There's so much information. I get there's overwhelm, but now the sites are getting so friendly. They've got this so dialed in. It's not as hard to look at taking a little bit of agency as it used to be. So we're going to talk about rebalancing and kind of what that is. It sounds very fancy. It's mostly just in actual practice. Remember when you fill out your form about your risk tolerance, and then they decide what you get to go into based on your risk tolerance and your time horizon? Rebalancing is just them shifting things around to feel that they've managed your overall risk in line with what you said was your risk tolerance. So keeping it kind of stable. It's kind of like trying to keep the risk tolerance a little bit more stable based on things that might be changing in the stock market. Like, for example, if bond returns are going way down or way up, they might need to rebalance a little bit because you said you wanted a certain kind of level of risk, and they're going to do things like that. It's a good idea to be checking in with your stock market portfolio, whether it's in the hands of a financial advisor or you're in charge of it yourself. Of course, you don't want to just do fire and forget for so many reasons, okay? And you do at times want to be thinking about risk and volatility according to your personal tolerance, because that's perfectly reasonable. Remember, this is a highly unstable part of your asset portfolio. So yes, you want to be taking a look at your risks. But I also want people to know that, they talk about rebalancing like, oh, give me all your money because I will rebalance you every quarter. And they show how they'll rebalance, and it seems very fancy. But also just know, rebalancing does not actually tend to increase your long-term investment returns. All it actually does is mitigate your risk. So that can work both ways. It can mitigate your risk maybe from losing, but it can also mitigate you out of getting better gains that you might have been able to get with some long-term plays. It also means a lot of fees. Every time they do that, they're charging fees for the work they're doing. And I want you to know there's something called churning. It's actually pretty rampant, where they're shifting funds simply for the sake of creating those fees, which I think is it's horrible. It's as bad as life insurance people who are selling a policy that's the wrong policy just to get that commission. That's also terrible. But I want you to know that happens with asset managers all the time. And I know this because a dear friend of mine who went to Stanford, who worked at Morgan Stanley, told me that. So I just want people to get like their eyes open. Okay, so ETFs, electronically traded funds, they're growing in popularity, and it's a fancy word again. Honestly, I didn't really know what it was when I first heard of it. It's basically just a mutual fund of sorts that has maybe like a different platform. They've got their own sort of solo platform to make an ETF available, or there are big carriers like Vanguard that will have ETF options. They are allowing you to take little pieces of something that represents access to a bunch of different stocks, right? And they have a fairly low barrier to entry in terms of the minimums in order to buy them. And they're designed in a slightly more efficient way as far as fees. It's just a kind of like a mutual fund, only very slightly different. And that's all I'm going to say for now. You can learn more about it if you want to, but we're trying to keep this fairly simple. So ETFs are actually a lot like mutual funds, okay? They're growing in popularity because they definitely can tend to have lower expense ratios, which is really good. And remember, like we talked about with all the fees, the compound interest of lowering the internal fees within your funds is massive over time. Like, can be tens to hundreds of thousands of dollars, massive, okay? ETFs don't have a minimum investment. So a lot of times to get into a certain mutual fund, you might need to have a minimum of $500 or $5,000 or something like that. I know that there's one with Vanguard, I know, where if I want to be in a mutual fund that's around oil and energy, it's $3,000 or up. I can't get into the fund unless I have $3,000. ETFs don't have minimum investments. So you can literally buy like one ETF at a time if that's all you've got. So it's easier to get in. There's no minimum. And they do allow for things called derivative plays. So derivatives are like, oh, I'm short on this stock. I'm long. I'm doing an option. I'm doing a put or a call. All those fancy things that I feel like I hear all these like 30-year-old men say. ETFs can allow you to do that if you really want to get into that kind of part of the stock market world. Whereas mutual funds don't really let you do that. They're just going to kind of take your deposit, allocate it, and spread it and grow it. They'll take care of the tending of it. The ETFs are a little bit more nimble and maybe can be a little bit more aggressive or can be a little bit more accessible. So that's part of the main reason they're growing in popularity, and they have these lower fees, which is awesome. As far as cons, there aren't a lot of cons, I'll be honest, especially compared to the whole stock market. But as of right now, you can't make automatic investments into an ETF, whereas our stock market portfolio with our 401k, I can be like, hey, please take 11% out of my paycheck. And then it's being done for me. And I love that, right? You can't just do that with an ETF. It takes like a little bit more administrative work. And, that's a thing because people love to be passive. So you have to be a little bit more engaged if you're going to do an ETF. There's a barrier to entry in that. This one's a minor one, but if you want to be a conscious investor in that, like, let's say I want to only align with principles or movements that are important to me. There aren't as many options sometimes for that with ETFs, although actually there are like green ETFs emerging now. There's even like a vegan ETF that's come out, things like that. So that's changing. And then they can be a little bit more limited in terms of which actual stocks you're getting to participate with inside that ETF, or there is such a thing as greenwashing, which is where they'll be like, oh, join this vegan ETF. And so if you're vegan and you're like, I love this, I'm a vegan ETF, supporter, but But then if you actually were to look, sometimes it's a little bit of spin, a little bit of BS, and they're charging 10% more just because it's vegan and it's like a sales spin. So just do your own research a little bit. It's always a good thing with anything. Okay, we're almost done. I know this is a lot, and then we'll get to questions. When it comes to picking stocks, right? Because there's also that beautiful kind of like idea that you can just pick stocks and pick them while they're down, and then they grow, and you made a ton of money, and it is really exciting. And I happen to know somebody in this room who's amazing at that. Okay, if you want to do it, just know it's like a little bit like gambling, right? I mean, the stock market itself is basically a kind of gambling, in my opinion. And so picking an individual stock is even more like that. Research is absolutely key. You don't want to just go to like your Apple feed about a stock and believe whatever it said, because those can tend to really over-report. Like one day it'll be like, oh, Roblox stock is way up. And 3 days later, it's like Roblox stock has underperformed. And like, that's not really going to be your best bet if you're doing research. You want to look at social trends, the core culture of an organization, and the leadership, the track record of that leader. Those are things I really like to look at. And a lot more reading and articles than just like your Apple feed. Those who are in the business of choosing the funds for people like American Funds and Capital Group, who are people I know as friends, they travel the world and visit companies, and they sit with the leaders and see what comes out of their mouth. And they choose to make these bets based on tangible factors, right? It's not just mojo, it's tangible factors. So as a person picking stocks, you can kind of do that too, if you're going to want to do this. Now, FOMO is very important. Do not let it drive you as to what you think you want to jump on, because a lot of times by the time you're hearing about it, it's like the train's already left the station. So don't use that as your main driver. And kind of like ask, how good are these sources and tips? Is it this kid off the street that just told me I should get this one thing? It's the same with crypto, right? Like if someone sneezes and mentions the name of a crypto, does that really mean you should go buy it? No, right? But then if you happen to know someone who's, I don't want to say insider info because that's illegal, but who is aware of certain trends and their logic makes real sense to you and you're thinking about it and that kind of resonates and the stock market price for it doesn't seem as high as you think it should be, well, then that might be a nice tip, right? One of the best rules of thumb I ever heard was if you're looking at a stock right now, and you're trying to decide whether to sell it or keep it. The question to ask yourself is, if I could, would I buy it again today at the exact price it is? And if the answer is yes, it's because you would be like thinking, oh, well, I know it's going to be higher later. So if that's the case, probably keep it, don't sell it. And if you wouldn't, then it might be an inflated stock. So that's a nice barometer. And then the other thing is just take little risks at a time and build on your successes. Don't go like all in because it can get really disastrous. It's not advisable. Remember, it's almost impossible to get this right every single time, or even nearly so. It's also very stressful and takes a lot of time and work. So be mindful of that. If you're not, this isn't the rabbit hole you want to be down, do an ETF, do a mutual fund. Maybe you don't want to just go trying to pick stocks. It's very easy to second guess yourself. I'm going to tell you a story. I was interested in Tesla stock when it was $18 a share. And this was like, 6 years ago or something. And I went to a networking event and there was this guy that went to Harvard. He was very arrogant. He was a venture capitalist and a fund manager or something. And I said, what I'm really looking at is Tesla. I think he's a brilliant guy. I love the way he's thinking, etc. I had all the reasons. And he was like, Tesla's going to be out of business in 2 years. They can't even keep up with production. No, Tesla's a joke. And you know what I did? I shut down and I didn't pursue my interest in Tesla. And that guy couldn't have been more wrong, obviously. So when you have these choices, and especially for women, I just believe in yourself a little bit. And also when you think you're making a choice and you think it might be going wrong, have a bit of a strong stomach, because if you sell too short and you don't believe in yourself, you can shoot yourself in the foot. So you do have to develop a stomach for this if you're going to try to go that way. And to help you, I want to share it. That guy, I saw him years later. I just saw him this year, actually. He's still succeeding. He got that way wrong about Tesla. And yet he's failed upward, right? He's managing millions of dollars for other people. So if that's the bar we're looking at here, don't hold yourself back. Like maybe give yourself a little bit of a right to maybe know something or at least guess something. All right. So finally,
sorry. Can you go back to that one? Or we can stay on this one maybe, but So Sonia put a really great comment in, and as we know Sonia really well, she is like fire when it comes to stock picking, like truly built an incredible portfolio and is really the epitome of what it means to pick stocks. Like it is work and you put in a lot of time to do it and those results follow. So she says, if you're looking to pick individual stocks for your portfolio, be sure to be clear on your goals, short-term versus long-term, do your research on the stocks and go for it. And your gut feeling is a big part of this. So that's also a really big piece because you were doing the Tesla research but there was a part of you that there's an intangible to it as well, right? Like there's the tangible way that we value stocks and look at them and look at their charts and their trends and their fundamentals, if anybody still looks at fundamentals these days. And then there's the, I think this is going to be something. And that's the confidence piece. And it also is that intuitive kind of gut piece. And so if you're going to do the stock picking, it's really important to stay the course as well and to have that resolve. And the other thing I'll say is just as with anything that when you choose and you commit to it, and it doesn't mean hold it when the whole thing is crashing, because there's strategies around like releasing it and then buying it back lower as well. But it's also really important not to get too, like we talked about, don't get caught up in the media headlines, because they're usually telling you the opposite of what's going to happen. And you can chart that back and see it. You can see that when they do fear media, actually the big institutions and whatnot are buying, because they're buying what you're selling and losing. And then they're selling when you're buying. This is like known, anyways, it's known by traders. And the other thing is, especially these days, and I kind of talked about in the beginning why Jennifer put stocks at the same tip of crypto. The stock market is trading with the same volatility, if not more, than crypto. We had an 8% swing the other day in a day. The average S&P return is 7% annually, but we had an 8% swing in one day. Why? Because there are always, now more than ever, everything is traded with bots, with AI, and they trade information at milliseconds, and it's causing volatility. There's also been, because of the massive increase in money supply, that money had to go somewhere. Where did it go? It went into the stock market. So a lot of the increase in most stocks isn't out of fundamental value of what that business is doing. It's because money had to go somewhere, and that's where it went. And so from a stock picking perspective, those are things to know as well, so that you know when is a good time to buy. You might be charting and tracking and knowing like, hey, like this is a really good value and it's on sale right now. Not buy the dip. That's not it. It's not buy the dip. Oh, every time it goes down, buy the dip. No, it's that, hey, this is actually on sale because it's actually trading at a price to earnings ratio, some kind of fundamental that you're like, I really believe in this. And it's trading at a really low price right now. And I believe in it. So I'm going to pick it up because it's on sale. So it's a bit of a paradigm shift in how we think about it. We can do it. We have to be really focused and no distractions, play the volatility in your favor. And as Sonia says, trust your gut.
Oh my gosh, I love that so much. That was such well-written and good advice from an absolute master, Sonia. Thank you for sharing that. And AdaPia, thank you for sharing all of that. I love the idea that we need to bring our TJ Maxx brain into stock picking. I think that is like brilliant. Okay. So what's the final kind of upshot on all this? I'm going to put this asset in its place. I'm so serious about this, guys. I think that when it comes to understanding stocks and the Wall Street thing, the reframe is the name of the game. There is so much intimidation. There's so much inflated importance and just so much self-dealing in it. And I just want to like poke that tiger and take it right down to a level of how does this sector serve you? And not let it feel over your head, because they've preyed on that, to be honest. Okay. And hopefully this helped you a little with that. Remember, don't contribute above the match in your 401k. There are better places to put it. Wall Street has been king, but things are changing. You know, in the 50s when technology and commerce were escalating, and it was really useful. And then this was one of the best ways. It was kind of like the original crowdfunding, right? It was analog crowdfunding in a way. And it did its thing and it was great. But technology has taken crowdfunding and diversification into a whole other realm. And Wall Street should not really be king, but it's still being given that level of credit. And I believe we need to be thinking much more outside the box and truly diversify. And there are so many more opportunities for a person to engage with growing their wealth than just that. Don't be intimidated. It's so much easier said than done. I just want to share in pure vulnerability. This was probably the hardest one for me to present. And I think it's because part of me was just like, well, I don't know. I mean, I'm not wearing a gray suit. I'm not a 45-year-old male. Like, there's still that part in the back of, I think, a lot of people's minds, especially women, that just ascribes the power and the ability in this arena to someone else who does not look like us. And I'm just going to call that out in the room because I've had 3 different advisors who've sold me out of Apple, UPS, FedEx, Disney, Tesla, and Square when it was $11 a share, all who were supposedly the best at what they do. And if that's the kind of world that we're in, I think we need a reframe here. And pay attention to the fees, right? I think that's one of the best ways to improve your margins. Also, look at that asset manager, really question what are they doing for you? What is the value? Are they actually really any better than if you just go straight to Vanguard and set up your own IRA? There are a lot of great resources on Vanguard. I'm a huge fan of Vanguard. And then just contextualize this. No, your stocks are your volatility. They are your high risk asset. They're as high risk as venture capital almost, in my opinion. And so remember, you need that pyramid of stability. You need those non-correlated assets. You need those things that are grounded and guaranteed that you can build upon so that you can engage in those higher risk opportunities, but without risking it all. So with that.